No, the shareholders are scattered throughout the world, and the operations of these kind of joint stock companies are more in number, more in volume. They are occupying a lot of significant role in the economy. So we just keep that 4 forms of business organization aside, and we are studying only the joint stock company form of organization, the accounting of joint stock company form of organization. That too, in your assignment also I have given you share capital. Okay, so what is a company? Any business organization registered under Indian Companies Act is called as joint stock company. Okay, which is having a share capital. Normally, which is having a share capital, that business organization we call it as joint stock company. The owners of the joint stock company can be called as shareholders, part owners, one of the owners. All the shareholders collectively called as the owners of the company. Okay, so as a company, it needs to prepare its financial statements once in a year, and it needs to get audited by the competent qualified chartered accountant, and it need to be published in the public domain. That is compulsory if your company is a listed company. But all the companies will do it. Companies, if I say any organization registered under Indian Companies Act. Okay, and there are some other companies which are doing exclusively a separate business. Suppose a banking company that has not been registered, that will not be registered under Indian Companies Act, but that will be registered under Banking Regulation Act 1949. Insurance companies are there. That also company only, but that will not be registered under, I mean, there are some specific companies, Life Insurance Corporation of India. It is not registered under Indian Companies Act, but it's also a company. Then where it is registered? It is a statutory company. What do you mean by statutory company? Any company which is incorporated based on a separate enactment. See, Reliance Industry Limited or Infosys Limited. These are all the companies registered under Indian Companies Act 1956 or earlier act. Okay, but HDFC Bank, okay, or you can say State Bank of India. State Bank of India is registered under separate act. State Bank of India Act 1956 is there. LIC, Life Insurance Corporation of India Act 1956 again. GIC, General Insurance Corporation of India Act 1972. So these are all the enactments for only one company, for only one corporation. Of course, they are also company, but they are bigger in organization nature, and they are governed by a separate enactment. If you have any separate enactment for that passed in Parliament, then we can call that companies as statutory companies. Okay, but anyhow, that's a small understanding about company. But now we are going to discuss about any listed company or any company. All companies need to prepare financial statement because to achieve the basic objective of accounting, to know the financial position and to know the financial performance. Financial performance is nothing but profit or loss. Financial position is nothing but equity, liabilities, and asset, which we studied under accounting equation. Okay, all the companies will prepare, all the companies. But the listed companies have to compulsorily publish those financial statements in the public domain. It is compulsory. Listed companies. What is listed company? What do you mean by listed companies?
Publicly open.
Just listed under the shareholder.
Stock exchange, listed in stock exchange.
Listed in stock exchanges. There is nothing called recognized company, unrecognized company. Nothing like that. Okay. All are registered under Indian Companies Act. Listed, if I say listed companies are those companies which allow their shareholders to buy and sell the equity shares of that company through a stock exchange. In India, we have two major stock exchanges, National Stock Exchange and Bombay Stock Exchange. Okay, if I want to buy a stock of Infosys Limited, I should not go to Infosys. I cannot go to Infosys. Infosys is very busy in doing its own core business. It wanted money. It has collected money from people like you and me long ago in 1990s. It collected. That's it. If you want to own Infosys, you cannot just go to Infosys and ask the board of directors, "Sir, I have 200 crores money. Please take these 200 crore and give me some shares in your company." That provision is not available. They are very busy in doing their business. They don't want to do this kind of arrangement of money here and there. So they already issued the shares and so many people bought it. Then suppose in 1992, when the company was issuing the shares, I purchased it. I want my money back right now. I am not supposed to go to the Infosys again. Sir, I gave you money in 1992 when you started your company. Okay, please take your share certificate and give back my money today's value. Please give me. That arrangement is also not there in the law. So meaning is the company has to do its own business without getting disturbed by its financier, without getting disturbed by anybody who has given money to it. So what arrangement is made? You can buy Infosys equity share, not from Infosys right now, but from the fellow investor who has already bought the Infosys share long ago. Then where that arrangement is possible, which is facilitating the buyer of Infosys equity share and the seller of Infosys equity share, that place is called as stock exchanges. Stock exchanges. Nowadays, it's all online. Nowadays, it's all satellite facilitated trading platforms are available. We can we can open the share broker website where you are having account. You can just give order to the share broker. He will execute your order. Okay. So the buyer and seller of the equity share, the company's equity share is taking place in a arrangement in a platform. That platform is called as stock exchange. Of course, physical place is also there. In Mumbai, if you go, you can see Bombay Stock Exchange and NSE also. Okay. So what I mean to say is listed companies are those companies which has already taken the permission from any one of the recognized stock exchanges to allow the buying and selling of the securities of that company. That is called listing. Suppose I am a new company. I think there are so many IPOs last week also coming in. Okay, Metro IPO has come. Have you seen? Okay, yeah. So many IPOs. When you go for collecting money from the public, that time itself you have to make this arrangement, because as soon as you allot the shares to the equity shareholders in your IPO, initial public offering, they will go to sell these equity shares the very next week or the same day, listing day itself, they will sell it. So for that, you should have already arranged, you should have an arrangement with some stock exchanges. Okay, so those companies are called as listed companies. All companies need not to be a listed company. Sir, I don't want my shareholders to sell their shares without my knowledge. Then you are called as private limited company. You don't let your equity, you don't let your shareholders to sell their shares without your knowledge. And number of shareholders are restricted. In public limited company, you have unlimited number of equity shareholders, unlimited numbers. Any number of shares you can issue, provided you should get the permission from Government of India through an authority called the Securities and Exchange Board of India, SEBI, SEBI, Securities and Exchange Board of India is giving the permission to collect money from the public by the companies. Okay. Sir, I can allow my shareholders to buy and sell my shares without my knowledge. It is between them. Let them do it. Those companies are called as public limited companies. Again, all public limited companies need not to be a listed company. All public limited companies need not to be a listed company. I am allowing my shareholders to buy and sell the shares without my knowledge, without my permission. Okay. But I don't want them to do it in the stock exchange. Let them do it on their own. X knows that Y is having equity shares of X, Z Limited. X and Y meets together in a private place. They just exchange their shares and money. If that is the case, that company is called as public limited but unlisted. Okay. Now the point, yes, sir. Okay. Yeah. So the point is, all listed companies should publish this statement to the public, not only to the existing shareholder. In the general public, they have to keep this statements. In their website itself, they have to keep it first, and then they have to publish it in the newspaper. You might have seen in April or May, these 2 months, all the leading newspapers will be having the balance sheet and income statement of companies. Even if you go to their website, it will be there in the digital format. They should keep it. Okay, all will prepare, but only public limited companies have to publish it. Listed companies have to publish it. Okay. Now, what do you mean by financial statement actually? Financial statements are those statements prepared by the companies or prepared by any business organizations to find out these two, profit or loss and financial position. Okay, profit and loss can be found out from a particular statement. That statement is called as profit and loss account. Financial position can be found out from a statement by preparing a statement. That statement is called as balance sheet. Okay, before going to that, just to see, this is only a general idea. What is a company? I already told you long back. Okay. Just I wanted to tell you a few more information before we go to the financial statement of the company. Yeah, this you know how the company is organizing its money. The company is organizing its money through debentures or borrowing loan, or getting money from the equity shareholders, or from preference shareholders, okay, or from public deposits. Public also can deposit money in the companies if they have taken the permission. Okay, so these are the ways in which they get money. The amount what we, who are you? We means, yeah, but all the time the shareholders giving is not equity. Preference shareholders also there. Preference shareholders. Capital only, share capital only. Share capital can be of two types. One is equity capital. Indian term is equity capital. International level, they are using the word called common capital or ordinary capital. Ordinary. Common stock, ordinary stock, equity stock. These three are one and the same. Okay, equity capital. Equity is more of accounting term. Equity. Okay. Equity capital. If you are getting money from preference shareholder, that capital is called as preference capital. Preference share capital. What is the difference between equity and preference capital? Equity capital is the owner's money. Their claim is residual in nature. Preference capital, the owners of preference capital is having some priority over equity share. What priority? First profit is to be given to preference shareholder. Suppose you are having profit in 1 year, you are going to distribute the profit among the owners. Before you give to common stockholder, you have to give to preference stockholder. And the rate of return given to preference shareholder is fixed. Just like a loan. Suppose you have given 100 rupees to a company, 100 rupees to a company as preference capital. In the certificate itself, the dividend, the return what we are going to get from the company will be mentioned. 10% preference capital. What do you mean? You will get, yeah, it's just like a deposit. It's a hybrid security. We call them as hybrid shareholder. Hybrid. Hybrid means what? It enjoys the benefit of debt and also it enjoys the benefit of ownership. Okay, we have ownership security, creditorship security. Ownership is equity capital. Creditorship security is debentures. In between these two, or the combination of these two, is there in preference capital. Whatever the profit of the company, preference shareholder will get the agreed amount of return. In my example, I told you 10%. 10% of the face value of the capital. In my example, 100 rupees is the face value. So you will get only 10 rupee as return. That is called a dividend, preference dividend. Dividend payable to preference shareholder is called as preferential dividend. That is prefixed. Suppose the company is under loss. Company is having loss. That time preference shareholder will not get any amount. Sir, you only told 10%. Yes, 10% is possible only when the company is having profit. That is why it is enjoying the characteristics of equity capital as well as the creditorship security called debenture. Debenture rate of interest is fixed. Similarly here also. But equity share capital will get the return only when there is a profit. That character is there for preference also. But when there is a profit, first you have to give to preference shareholder. How much ever is agreed, that much amount to be given. Second priority. Suppose the company is closed. The company is wound up, liquidated, dissolved. The company is no more available. That time you are selling all the assets of the company. You are going to settle all the liabilities. I hope you are all familiar with these words now. Assets are disposed of. You collected cash. All the assets are disposed. You kept cash in your hand. And there are liabilities lining up to be settled. After settling all the external liabilities, if any amount is available, first you have to give to preference shareholders. Even after that, if there is any amount, that amount all is available to equity shareholder. If it is nothing available, suppose no amount is available after settling to preference shareholder, then equity shareholders will never get any amount from the company. That is why we call it as residual in nature. The claim of equity shareholders in the company is residual in nature. Though they are owners, they are residual owner. Okay, fine. Yes, sir. No. In debenture, one of your friend is asking, what about the payment of interest on debenture? It's a loan. It's a loan. Suppose you are taking education loan, not you. Your friend is taking education loan. He failed in the EMBA examination. Will the bank tell you that when you pass, you pay the interest? No. We agreed upon to pay the interest, whatever happens. That's why it's called creditorship security. Suppose you earn so much of money, are you going to give some extra money to the bank on the loan more than the interest rate? No. That time you will tell, I agreed to pay only 8%, take only 8%. Whatever profit you earn, that's all for the shareholders. So they are called as creditorship securities. Creditorship. What is the characteristic feature of creditor? Whatever happens to the company, no matter. I have given you 1 lakh, 10% interest, pay me 10,000 rupees every year as interest. Whether you are live or dead, or you are not having profit, or having profit, or too much profit, less profit, no matter. At the end of the maturity period, you have to pay back the principal also, the 1 lakh rupee. That's the arrangement. Okay. Nothing doing with the profit of the company. Any other doubt before we proceed with the capital? Look at this. The capital, total capital allowed by the SEBI is called as authorized capital. How much amount you are going to collect from the public? That's called authorized capital. How much amount you are allowed to collect is authorized capital. How much amount you are collecting now is called as issued capital. I got a permission for 100 crore to collect from the general public. But right now, I am in initial stage, I want to collect only 60 crore. Remaining 40 crore I will collect later when my company gets expansion. Okay, that is called issued capital. Then subscribed capital. You are ready to collect 60 crores from the public. You are issuing an IPO. But how much the public is ready to subscribe from your company? They are subscribing only 55 crores or 58 crores, something like that. Okay, subscribed capital. Then called up capital. Public has ready to give you 60 crores right now. Subscribed is 60 crore. But you are in the very initial stage. You don't want all the 60 crore immediately. You want only some 30 crore or 20 crore immediately. Remaining 40 crore you will collect it from the public little later, after 2 months or 3 months or 5 months. So that capital is called as called up capital. How much you are asking them to pay. How much they pay is called as paid up capital. So these are all the different nomenclature what we use in the balance sheet. Subscribed, called up, paid up. See, authorized is how much you are allowed to collect. Suppose UGC is giving you permission to conduct MBA class for 60 students in a class, 60. I'm giving an advertisement. I'm getting application more, but I'm selecting only 50 students. 60 is authorized, 50 is issued. I mean, issued. Okay, issued as well as subscribed. I asked for 60, but I have got only 50. I got applications more, but I selected only 50. During the class, okay, financial management, so many classes are there, 1 or 2 is having some problem, they are leaving. That is final stage. So authorized, issued, subscribed, called up, paid up. Okay, look at the last one, another one, something different. Reserve capital. What is reserve capital? The difference between the authorized capital and the issued capital is called as reserve capital. Reserve. I kept it reserve. Okay, I will use that capital later on. I did not even collect it. Okay. Okay, fine, no problem. Come now, the financial statement of companies. We have 2 statements. One is balance sheet. 2 statements we have. Statements. 2 statements. Look at this. These 2 are the financial statements of companies. Generally, balance sheet, or you can call it as position statement. Second one is income statement, or you can call it as profit and loss account or statement of profit and loss. Okay, statement of profit and loss. These 2 statements only we are going to prepare, and we are going to read as a executive or as a analyst. You should be able to read these 2 statements of the companies, and you should be able to analyze it. Before that, if I teach you how to prepare it, then only you will be having the idea about the different items which are appearing in the financial statements. You are not going to prepare anything, but you are going to read it, you are going to analyze it. So if you want to read and analyze, you should be knowing how it is prepared. What are the nuances in preparing this? How the variables are appearing in the data are appearing in the 2 statements. Okay, first statement, that is balance sheet. Look at this. This is the balance sheet. One small instruction to all those who are already knowing accounting, BCom, BBA, or somebody. In exam, you have to prepare these statements only in this format, what is just showing here, what is shown here in the screen. You might have studied preparation of profit and loss account and balance sheet. You should not do that here in this company form of organization. Why? I already told you, it is mandatory to prepare the profit and loss account and balance sheet by the companies according to Companies Act 2013 now. Okay, so Companies Act 2013 is stipulating the format in which you have to prepare. Schedule 3 of the Companies Act. Each and every enactment will have schedule, sections, subsections, like that, right? So Schedule 3 of the Companies Act 2013 is giving us the format of the balance sheet. The rules and regulations, the double entry bookkeeping system, accounting procedure, everything is same, but only the displaying format is different. You might have done it in a T form, just like a ledger account. You might have prepared a trading account, profit and loss account, and all those things. But here there is no trading account at all. Those who are engineers, okay, no problem, for no worries. But those who are BCom, you already learned something. You have to unlearn that. We are not going to prepare any more trading account. Companies Act is not telling you any more trading account. Only profit and loss account and balance sheet. Okay. So balance sheet, you already know we are having accounting equation. That accounting equation is going to be rewritten in a statement form. That statement is called as balance sheet. So balance sheet is having two aspects. One is Roman letter 1 is equity and liabilities. Another one is assets. Can you remember, recollect, the asset is always equal to the value of asset. Equity plus liabilities. Very good. Equity plus liability, external liabilities. Okay. That same equation is going to be redrafted in detail in a statement. That statement is called as balance sheet. Balance sheet is a statement which displays assets, liabilities, and equities in a statement form. That's it. Okay. Look at the statement. Two component I told you. One is equity and liability. That's the first component. Second one is assets. Okay, in this form only you have to prepare. Okay, first one I just explain. To prepare a balance sheet or to prepare income statement or to prepare totally the financial statement of a company, what we need? Overall, okay. So can I come and tell you a story? In 2022, just 1st January, I just bought goods for 2,000 rupees. 3rd January, I sold that goods for 3,000 rupees. Huh? That backup in accounting we call something. Sorry. So after you come to post graduation, you have to start from 4th year. Again, if you go to 1st year of your BCom or engineering, that's not good, no? Yeah, then what is that? Sorry?
Trial balance.
Somebody is telling, yes, sir. Trial balance. You already got one degree, that's okay. Already somebody given a degree. Now, based on that, you are going to the next stage. Again, if you want to check again, 1st year onwards, school, first LKG onwards, if you start, again, same process will be there. Everything is done. We are having one statement with us. That statement is called as trial balance. So to prepare the financial statement of any business organization, we need base as trial balance. Trial balance. Whatever he told is correct. Whatever he told is correct. But all those things are reflecting in single place that is called trial balance. Bill, transaction, everything. Purchase, how much I spent, how much I sold, everything is true. But all those things are already in an abridged form, in a what you can say, yeah, statement form. That is called trial balance. In addition to that, on the time of preparing trial balance, some transaction might have taken place. See, it's a time we cannot say the customer, sir, please wait. We are preparing a trial balance. You come and pay the money tomorrow. Then he never comes. So you only don't want the money. Then how do I come? Okay, one customer is coming and is buying something. You're telling, sir, today we are just taking accounts. Today we are closing the books of accounts. Trial balance we are preparing. Come tomorrow. You are losing a sales. So there are so many transactions that are happening every time. That time only we are preparing a trial balance also. So there are some information, some transaction actually, which has not been entered in journal, ledger. Obviously, it won't be there in the trial balance. It's just a raw transaction. The raw transaction which have not gone through any accounting process is called as adjustment. In accounting, we call them as adjustment. Suppose you bought goods for 10,000 rupees. 5,000 units you bought for 10,000 rupees. But you sold 2,000 units for 12,000 rupees. Understand? You bought 5,000 units for 10,000 rupees. You sold 2,000 units for 12,000 rupees. How many units are left out with you? 3,000 are left out with you. This will never reflect in any of the books of accounts because it's left out. It's stock taking. That time you will be finding physically 3,000 units are lying down. Okay, it won't be there in any of the books of accounts. So you have to value that stock. You cannot simply say, sir, I sold for 12,000. I bought it for 10,000. So my profit is 2,000. If you say that is wrong. Because still you have 3,000 goods, 3,000 number of units, which is going to be sold in the next accounting year. So that is still there. That is an asset for you, which you are going to sell it later. So that you have to calculate. So that is called closing stock. Like this, there are so many transactions which need to be taken into consideration, which has not gone through any of the books of accounts. Those are called as adjustments. Say, for example, rent you paid 15,000. 15,000 rupees you paid rent. Okay, for 15 months. But you're closing your books of accounts only for 12 months. That means you paid rent in advance for the next accounting year. How much? 3,000 rupees. You paid in advance. How do I know? 15,000 is for 15 months. Then per month it is 1,000. 12 months is my accounting period. 3 months I paid for next accounting year. What should you do? Now, how much you have to consider as rent in the books of accounts to prepare your income and profit and loss. 12,000 only you have to take, right? Original amount is only 12,000, but you paid 15. That 3,000 is your asset. Instead of you keep that 3,000, you given to your landlord. So you have to minus that 3,000 rupees from the 15,000 rupees total rent paid. This 3,000 is called as rent paid in advance. Expense paid in advance. Any expense paid in advance, you have to minus that amount which is paid in advance from the total expense paid to find out the real expense to be minused from the income. What is profit actually? Profit is equal to income minus expenditure. Okay, so these kind of things are called as adjustments. Okay, so balance sheet is one and another one is adjustments. With the help of these two, we are going to prepare income statement or profit and loss account and balance sheet, otherwise called as position statement. Got it? Okay, now look at the components of balance sheet first. I already told you balance sheet is going to give us the liability detail, equity detail and asset detail. The first component is liability and equity or equity and liability. Okay, look at the very first one. Very first one is shareholder fund. What is shareholder fund? How much you collected from shareholders. In the trial balance, you'll be having share capital, X amount. Bring that amount and write it here. That's it. Share capital. There are two subcomponents under shareholder fund. Look at this. One is just share capital. The share capital includes equity as well as preference also. Equity as well as preference. Equity as well as preference. Okay, but you need not write the title over there. Suppose preference is 50,000, equity is 1 lakh. You have to write here share capital how much? 1,50,000. The detail of that you have to give it in a note. That is called note number. Look at the format. Particulars is there, note number is there, then the amount for the reporting period. What is that amount for the reporting period? The current year. Normally in practice, they will be preparing in two columns. One column is for the current year, one column is for the previous year. The current year is 21-22. Current year is 21-22. 31st March 2022, I will prepare. The last year is 2021. 31st March 2021, I should have prepared. Now, 22 March, I will be having two columns. One column is for 22, another column is for 21. Since it's just an academics, we just remove that one column because we need to know how these items are going to appear. Which year does not matter. Okay, if you know for 1 year, you can do it for any number of years. So I have left the another column. Okay, normally it will be two columns. Figures at the end of the current reporting period and the figures at the end of the previous reporting period. Okay, now you have to prepare a small note to give the detail about how much amount is appearing here. Suppose here it is appearing here 1,50,000 in the name of share capital. If it is 1,50,000, how that 1,50,000 is arrived? You have to give a note. That is called accounting note. That number you have to write it. There are so many notes will be there. Each and every detail you have to give it in a note. All those notes to be serially numbered. Serially numbered, starting from share capital. So share capital will have a note number 1. So how do I know how much amount? From trial balance. In trial balance, I will be having share capital. By this time, you might have prepared your assignment. In assignment, you will be having one account called share capital account. In our example, share capital account is 100 crore, I think. 100 crore or 1 crore? 1 crore. 25 lakhs is contributing. 25 lakhs equity, all are equity share only. That's a confusion always you are having. How much the person who is what's the name? Surya is contributing. Surya is also one of the shareholders. So how much he is giving? 25 lakhs. The 25 lakhs itself is a share capital. And he is collecting from general public. How much? 25 lakhs. So total share capital is 50 lakhs. Okay. Is there any preference capital? No. So you have to write in a note share capital. Under that you have to write how much one share is 10 rupee, right? 10 rupee. So number of shares, how much will be? 5 lakhs. Sorry. How much? 5 lakhs into 10. So you have to write in the note share capital under that 5 lakhs equity shares of rupees 10 each. 50 lakhs. You have to bring that 50 lakhs here. By chance, there is only one. So we are writing only one in the note. Sometime there will be 3, 4. 10 rupee share, 1 lakh. 5 rupee share, another 5 lakhs. Something will be there, means you have to write one by one. Take a total. The grand total you have to bring it here in the share capital column. Okay. Next, reserves and surplus. What is reserves and surplus? Up to now, how much the company has earned, up to current year, how much this company has earned, plus current year earnings. Listen very carefully. Reserves and surplus. Surplus means current year profit and last year profit. Up to now, how much I have earned. Reserve means how much I have taken from the profit and kept it for future purpose. How do I know this? From the profit and loss account, you will be knowing the profit. Current year profit and loss account, you are going to prepare income minus expenditure. From that, you can understand how much the profit of the current year. You have to add that profit of the current year with the previous year profit and loss account. That will become surplus. Suppose the board of directors decided current year profit is 1 lakh. Out of 1 lakh, 60,000 rupees we are going to keep it in reserve. So 40,000 only will be the component of surplus of current year. So last year surplus is 1 lakh. So total surplus of the current year will become 1 lakh 40,000. That is under surplus. Reserve. Up to last year there is 60,000 reserve. Current year reserve I have made 40,000. So reserve will become 1 lakh. So total you have to write it here. Total. Though you are having note for reserve and surplus separately, you should have both together and you have to write it here, reserves and surplus. I explain again, reserves and surplus are nothing but the undistributed part of the profit. Undistributed part of the profit. Okay. Next, how to calculate? Up to last year, what is the profit? Plus current year profit. Minus how much you are allocating for reserve from current year profit. Left is called as surplus. Last year's reserve plus current year allocation to reserve put together is called as total reserve. Now, total reserve plus surplus put together, you have to write it here. Okay. Yes. We will do it. Okay. Next one, component number 2 in the main component of equity and liability. That is non-current liability. Non-current liability means long-term liability. Long-term liability. Example for long-term liabilities are long-term borrowings from banks and financial institutions. Deferred tax liability. Deferred tax liability means you have to pay some tax to government of India. You did not pay. You are still keeping it payable. That won't come here. Okay. Other long-term liabilities, except these two, any other long-term debentures will come under long-term borrowings. Debentures will come under long-term borrowings, bank loan, debentures, all those things. Other long-term loan, you might have taken loan from the board of directors for long-term, or the family of the board of directors. Okay. X is the board member. Mrs. X has given loan, long-term loan, possible. Okay. So that kind of thing, long-term loans. Long-term provisions means, actually provision means what? Provision means an amount which is kept, which is charged against profit in anticipation of some loss in future. Bad debt is a possible loss in the future, but that is short term. Okay. If you have anything like that, there is one case pending against court of law. Court is having a case against you. Somebody filed a case to claim some compensation. We don't know in whose favor the case will be settled. Okay. Suppose in future, next 2 years in India, we know the civil court or any kind of actions, compensation. Yesterday I saw one news. After 33 years, one case was settled for some 420, I mean fraud. Okay, so we have some process in court of law. We don't know how it will go and when it will finish. Suppose if I am penalized by the court of law, I have to take money from my business and I have to settle. For that purpose, I keep some arrangement right now only. That kind of things are called as long-term provisions. Provision for workman compensation. Provision for workman compensation can be an example. Okay, if it is there in the trial balance, this will come. This will definitely there. This will definitely there. These are all options. These are all depending upon the company's financial policy. Please understand that you will be studying in the next semester in the financial management or corporate finance. Some subject will be there. There you will study which is good for the company. Here, accountant just we are recording what is company doing. That's all. Next stage you will go to decide about the structure. This is called capital structure actually. Capital structure of a company. The finance manager, CFO, will decide about these kind of things. Based on that decision, the amount will appear here. This is compulsory. Without this, no company can be there. Okay, this also possible. Most of the time possible. Okay, but these are all the things optional. Optional means not to write here. If the company decides to borrow, it will come. In the trial balance, if you have anything called debentures, please understand, you won't have same words in the trial balance. The same words will not be there. Debentures, bank loan, provision for workman compensation, those kind of things will come. So you have to take accordingly in the separate heading by preparing a note. Okay, next, third one is current liability. There's number missing. Okay, mistake. Third one, current liabilities. Current liabilities. What is current liabilities? Short-term liabilities. Short-term liabilities. Okay. Example for current liabilities: trade creditors. Okay. Bills received, bills payable, outstanding expenses, all those things. If it is there in the trial balance, take those items and bring it here and write it. Short-term borrowings, trade payables. Trade payables are nothing but trade creditors, accounts payable, bills payable, everything put together is called trade payables. Okay. Short-term borrowings, bank overdraft, short-term loan from a bank or any other financial institution. Other current liability, except these two, other current liabilities. Short-term provision is nothing but provision for bad debts, provision for doubtful debts. These things will come under. Okay. So if you have all these things, you have to take a total. That total is kept here. The same amount will come under the total of asset as well. Okay. Assets. Look at this asset side. We have non-current assets. Non-current asset means fixed asset, long-term assets. Okay. Example, land and building, furnitures, motor car, motor vehicle, computers, everything. So we have two types of fixed assets: tangible, intangible. So far what I told is tangible. That should be written in the tangible asset column. You have to prepare a separate note, note number maybe 5, 6. Serially you have to number it. Okay. So all the tangible assets you have to prepare under one note. The total of that will come under here. Okay. Now one adjustment you may come across. Suppose in the trial balance building value is 5 lakhs. Okay. And you decide this building value is keep on reducing year after year. Or take an example, machine. You bought it for 1 lakh. It is there in the trial balance 1 lakh. Machine account, trial balance asset debit side 1 lakh is there. But you have used that machine for 1 year. Now the machine is going to be depreciated every year. So in the adjustment in exam, we will give you depreciate the machine at the rate of 10%. What does it mean? The machine value has come down to 90%. 10% is gone. You have used it. So what should you do? You have to write here machine account as 90,000 only. How? Machine original value is 1 lakh minus depreciation 10,000. 10% of 1 lakh, 10,000. So remaining value is 90,000. So depreciated value will be shown under the balance sheet. Okay. What about the 10,000? Where you will write it? While preparing the profit and loss account, under expense column, you would write 10,000. Okay, depreciation. Okay, now intangible assets. Intangible. Goodwill, patents, trademark, copyright, all those things will come under intangible assets. Similarly, in intangible assets also there may be a depreciation, but we call that as amortization. Reduction in the value of intangible asset is called as amortization. Amortization. Okay, amortization. If anything is given in the question, suppose goodwill is 5,000, I say 5 lakhs. Okay, amortize or write off the goodwill 20%. So 5 lakhs into 20%, 1 lakh should be written off. How much you have to show here in the intangible asset in the name of goodwill? 4 lakhs. That 1 lakh will be shown in the expense. Same logic. Okay, good. Next, suppose you are just doing a construction work. It's not finished. Construction, you bought a land and you are constructing it. How much the value of that construction till now? That should be shown under the capital work in progress. It won't be there normally, but if it is there, you have to write it here. Okay, intangible assets under development. You are doing only R&D and you have filed a patent application to Government of India. You found out something, you invented something. Okay, for that you are claiming some patent. Still not allotted, still not given you the license. Okay, that time how much you are estimating, that amount you can under development you can bring it here. Normally these two won't be there in general, only tangible asset, intangible asset. But if it is there in your company, you can bring it. Suppose software, you are making a software, 90% over. Okay, you're waiting for the approval from the concerned department to give a license for you, copyright. That time you have to write that amount here, how much you spent, you have to write it here. If it is there in the trial balance, it will come here. Everything is only from trial balance only. Nothing is based on your imagination, based on your any other records. Only from trial balance. Reference point is trial balance. Okay. Next, current assets. Cash, stock, inventory, work in progress, sundry debtors, bills receivable, cash in hand, cash at bank, everything will come under current assets in this name A, B, C, D, E, F. Okay. Current investments, you have purchased some of the shares of other companies, or you have made some fixed deposit in the bank. Okay, investments. Inventory is nothing but closing stock of raw material, work in progress, and finished goods. Okay. If it's a manufacturing company, if it's a trading company, only one will be there. Inventory, only finished goods. Next, trade receivable is nothing but bills receivable or sundry debtors. In your trial balance, if you find sundry debtors and bills receivable, you have to group that under trade receivable category. Okay. Then cash and cash equivalent, meaning bank balance and cash balance. Cash account in the trial balance, bank account in the trial balance, added together, it will come under cash and cash equivalents. Okay. Next, short-term loans and advances, what we gave to others. Short-term, you can wonder, sir, how loans and advances are asset. We have given loan to others. Okay. Then except all these things, any other current asset is there, you have to bring it here also. Okay. Say for example, prepaid expenses. Prepaid, you paid expense in advance. I told you insurance premium, rent, anything of that nature, that you have to bring it here, other current assets. So this is the format of balance sheet. Any doubt up to now?
Excuse me,
Advance, one second. Yeah, advance payment. We made an advance payment to the supplier. That will come under other current assets. Advance payment to our supplier. We did not buy any goods, but we have paid money. We are going to buy it next month, like that. Yes, sir. So somebody is online asking something.
Yes, sir.
Yeah.
Sir, if your business is getting additional contribution from members in the form of cash or assets like furniture,
Additional
contribution to capital.
that might have been already entered in the journal, no?
Yeah. So in the balance sheet, where will it fall?
No, what is the entry you will make in the journal?
In the journal, it will be a bank account to the capital account of that particular
If
member.
that is the case, that would reflect in the trial balance. No.
Right.
In what name?
In that that person, particular person's name.
No, particular persons. Why you are bringing a person here? Just now I told you, no, you
Additional.
cannot go to Infosys and give 1 lakh rupee and ask the share certificate. You
Okay.
can't do that. Once it is done. That's all. New share is issued means okay. Infosys itself coming to the public and issuing new shares. That's okay. But all those things are not recorded in your own name. Please understand.
No, I'm talking about some new, like suppose it's somebody is starting the business.
Okay.
And somebody is like partner or somebody is
partner. Just now, I think you
Oh,
joined the class a little late. I think I told you in the very beginning, we are not concerned about in this class the
Okay.
4 things. What are they? Sole trading, partnership, HUF, and
Sure.
cooperative or form of organization. We are not worrying about all those people. If that is the case, you will be writing like this: cash account debit 10,000 rupees to A's capital account or B's
Okay,
capital
okay.
account,
Understood.
C's capital account. Okay, that will be reflecting in the trial balance in the name of A's capital.
Okay.
That will come under the balance sheet, but that balance sheet will not be looking like this. That balance is different. Balance sheet of partnership firm, which we are not studying here. Yes.
Okay, sir.
Okay. So right. So the next one is income statement. The format of income statement is also given in the Companies Act 2013 in part 2 of the schedule 3. Okay. It looks like this. Same format. Serial number, particulars, note number, figures at the end of the current reporting period. Same thing. Okay. What is profit actually? Profit is nothing but
income minus
Excess of income
expense.
over
expenditure.
expenses.
Same thing we are going to do here. Look at this. The first 2 are income. The total of that is total income. Then all are expenses. Fourth number is expenses. And then we are taking a total of expense. Fifth Roman letter represents the total expenses. From Roman letter 3 value, we are minusing the Roman letter 5 value. That is profit. Okay. It looks very simple, but actually we have to know what are the items to be recorded in the revenue from operation and what are the items to be recorded in other income. Okay, first I'll tell you, revenue from operation means any income received by the company from the core activity of the company. Suppose tuition fees collected by Dayananda Sagar University is going to be the revenue from operation for the university. Suppose we have a canteen inside. That's possible, right? We have to facilitate. There's a canteen provision. We are letting it out to some of the catering people. We are letting it out. We are receiving some rent for that, nominal rent, to provide the food for subsidized food to the faculty as well as the students. We are letting our own part of premises to the catering people. Suppose every year 1 lakh rupee you are getting as a rent from that cater. Okay, that 1 lakh is not a revenue from operation. Letting out the building is not the prime business of the university. Then that will come under other income. Suppose we are keeping 2 crore rupees as a fixed deposit with some of the sanctioning bodies of academics. They're demanding to keep some 2 crore rupees in deposit. In our name, in a bank, we are depositing that 2 crore receipt we are showing to the regulating bodies to get approval for some courses. Same thing for other industry also. Same, I'm just taking an example, I'm telling. That 2 crore is giving you interest. Bank is giving you interest. 20 lakh rupees you received interest as bank interest for 1 year. That 20 lakhs will come under other income. Suppose you are a bank. You lent loan. Then you are getting interest from the customer. That time that interest will become revenue from operation. So it depends upon the business, whether it is revenue from operation or other income. Okay. So sales income is mainly revenue from operation. Sales is revenue from operation. Okay. Other income is nothing but sale of old furniture, sale of newspaper, getting of interest from other bank for our deposit. all those things. Okay. So revenue from operation, how do you calculate? If you are having a trial balance, sales minus sales return is going to be your revenue from operation. Sales minus sales return normally. Okay. Other income can be interest from bank, commission received, or rent received, something like that. Next, you take the total of these two. Before that, I'll tell you one more thing. Suppose you deposited money in a bank, interest is not due, but interest is earned. You understand what I'm saying? Interest is not due, but interest is earned. Meaning is, you are depositing the money on 1st January. Bank is going to give you first interest on 30th June or 1st July. But you're closing your books of accounts on 31st March. Will you receive any interest from the bank on 31st March in this agreement? No. When will you receive the first interest? June 30th. But have you earned any interest from the bank? Yes, you earned. How much you earned? Up to 3 months. For 3 months you earned. So that interest you have to calculate for 3 months, and you have to write it in other income category as interest receivable. Interest receivable. And same thing you have to write it in balance sheet also. What is this in balance sheet? Other current asset. Please understand, any adjustment which you are having after the trial balance, that should be recorded in two places. That should come under two places. One in profit and loss account, another can be in balance sheet. Because double entry bookkeeping, the transaction itself is not recorded anywhere so far. It is freshly incorporated in the books of accounts, directly in the final stage, that in the financial statement. So to satisfy the double entry bookkeeping system, it will appear in the two places. Say for example, closing stock. Closing stock is given the question 20,000 rupees. What to do? Closing stock. Closing stock is an asset. So in the balance sheet, you have one line called inventory, right? There it will come. One point. Another point is you have to minus it from the, look at this point number C, I'll tell you. Changes in inventories. Opening stock minus closing stock is equal to change in inventory. So here also you have to take that closing stock. So the point is, if you have any adjustments, that adjustment should be appearing in two places to satisfy the double entry bookkeeping system. Okay, right. So other income plus revenue from operation put together is called as total revenue. Total revenue. From this, you are going to minus the expenses, but expenses are going to be categorized by Companies Act by in the name of A, B, C, D, E, F, and G. What is A? Cost of materials consumed. This will come only for manufacturing companies. Cost of materials consumed. How do I calculate from the trial balance? What is the purchase of raw material plus opening stock of raw material minus closing stock of raw material is equal to materials consumed. Simple logic. See, when I start the business today morning, I had 5,000 worth of raw material. I bought 10,000 worth of raw material in the day, during the day. So total materials available for me for consumption is 15,000 worth of raw material. At the end of the working hours of today, I still find 3,000 worth of raw material without used. Then how much amount of raw material I have used? 12,000 rupees of materials I have used. Same thing is for 1 year. Opening stock of raw material plus purchase of raw material minus closing stock of raw material is going to be equal to materials consumed. This will be only for whom? Manufacturing companies. If your company is not manufacturing anything, you have to write it here, nil. That's it. You are only a trader. You are buying and selling. You need not worry about this column number A, I mean row number A. Second, point number 2, purchase of stock in trade. What is purchase of stock in trade? This will come only for trading companies. Trading companies will buy and sell. That's it. They don't add any value to the material. They don't process. They don't do any conversion. They just buy. Suppose toys I am buying, showcasing it, and I'm selling it. That's all. If that kind of business is there, then there will be a trial balance. In the trial balance, you'll be finding an item called purchase of stock in trade. Stock in trade means finished goods you are buying and you are selling. That's all. That's called stock in trade. Don't confuse the word closing stock of raw material and stock in trade. Stock in trade is only finished goods. Okay, you got it? In doubt up to this? Expenses, purchase of stock in trade. No need of doing anything, just write purchase of stock in trade. That's all. Third one is change in inventories of finished goods and work in progress and stock in trade. Look at this point number C does not worry about materials, closing stock, opening stock, because that is already done in point number A. Opening stock of raw material plus purchase of raw material minus closing stock of raw material has been already done in point number A. Point number C is worrying about opening stock of work in progress, opening stock of stock in trade, and opening stock of finished goods. Add it together minus closing stock of these three, except raw material. I repeat again, point number C, how do you calculate? Opening stock of finished goods, opening stock of work in progress, opening stock of stock in trade, minus closing stock of finished goods, closing stock of work in progress, and closing stock of stock in trade. Sometimes you'll get minus answer also. You can write it here. No worries. Change in inventory. What is the change? Opening to closing, what's the change? Opening is 5,000, sir. The total of these three, finished goods, work in progress, and stock in trade in opening is 5,000. Total of these three in the closing is 7,000. So how much you have write it here? Minus 2,000. Minus 2,000. 5,000 was there. Now it is 7,000. So change is minus 2. Suppose already 10,000 was there. Now it is only 6,000. How much you have write it here? 4,000. You have write plus here. Okay. If it is minus, sorry, whatever it is, it will be in adjustment only. The closing items all will be there in the adjustment only. You have to consider all those things. All those closing inventories would come under balance sheet in the name of inventory, irrespective of material, finished goods, work in progress, and stock in trade. But normally what happens, the companies will be either trading business or will be a manufacturing business. Okay, that's all. Suppose if your companies are doing both, then entries here also will come, here also will come, here also will come. Okay. Next, fourth one, all expenses relating to salary, bonus, benefit to the employees, all those expenditure. You may have in trial balance, salary, bonus, commission to the employees, okay, welfare expenses, canteen expenses for the employees, whatever it is there, all those things put together in a note. You have to bring the total of that here in the name of employee benefit expense. Employee benefit expense. Any expense relating to the employee will come under this category. Okay. Next, finance cost. Interest and bank charge. Suppose you have paid interest 5,000 rupees. Bank has charged 2,000 rupees as bank charge. All those things will come under finance cost. Any cost which is relevant to loan or any finance. Suppose bank is charging you for dishonor of check. Bank is charging you for not maintaining minimum balance. Bank is charging you something for annual charge. Okay, everything will come under this category. But major item is interest on debenture, interest on bank loan, interest on any other loan. Okay. Penalties of what? To whom? Any means what? Any is not possible. You have to tell the specific one. Any what? Bank. Everything. Suppose your EMI is 2,000 rupees per month. 1 month you missed it. Okay, automatically there will be a debit in your bank account. Penalty, fees. On the top of that, GST will also be there. Everything will come under here only. Okay. That won't come here. No, that's how can you call that as a finance cost? We kept no. Always in all, you can, by the time you may notice, in all the categories, one item is there in the last, other like that. So these are all will come under. Okay. Yes. So finance cost, then next depreciation and amortization. Just now I explained to you, any reduction in the fixed asset is called tangible fixed asset is called depreciation. Intangible fixed asset is called amortization. Both put together, you have to bring it here. In our example, I told you 10,000. Out of 1 lakh, 10,000. Then goodwill out of 5 lakhs, 1 lakh rupee. So 1 lakh, 10,000 rupees, you have to write it under depreciation and amortization example here. 1 lakh, 10,000. Depending upon the asset value. Okay. Then other expense, apart from this, now we are clear about A, B, C, D, E, and F. Apart from this, any other expense is there that you have to bring it in the other expense. Example, advertisement, delivery van charges, penalty, what you told to the regulatory bodies. Okay, donation given, everything. Puja expenses, sundry expenses, trade expenses, everything. Okay. So now total this A, B, C, D, E, F, G. Total this and write it here, total expense. Already we have total revenue in the column number 3. Okay, Roman letter 3. From that you minus total expenses. That is going to be your profit before tax. Then minus tax, you will be getting the profit after tax. That's it. Minus tax given in the question. Okay. Remaining is called profit after tax. This profit after tax is called a surplus of the current year. Surplus of the current year. In the trial balance, if you find one profit and loss account, trial balance will be having one item called profit and loss account. If it's an ongoing business, in your trial balance, what you're preparing for assignment, it won't come because it's a new business. Ongoing business will have a trial balance. In the trial balance, you may find profit and loss account also as one of the items under the name of the accounts. Suppose 2 lakh rupees is there in the credit side of the trial balance in the name of profit and loss account. That is surplus of last year. This surplus you take, current year surplus, add it together, minus any amount to be taken away from that as reserve. Remaining is closing surplus. That surplus, that reserve what you're taking from the current year should be added with the previous year surplus. Put together is called up to today accumulated surplus. Okay, both you add it together again. You'll show it in the balance sheet in the name of reserves and surplus. Okay, so this is the format of profit and loss account and balance sheet. Yeah. Yes. Okay, look at this. This is a balance sheet. Am I right? Yeah, it's a balance sheet of one of the companies. It may not be that much visible to you. I request all of you, if you are working in a public limited company, you go to your own company's website. 2021 balance sheet will be there. Income statement will be there when you are free. Okay, or allot some 5-10 minutes time and you just go through that real time balance sheet. Look at this, same thing is there. Current assets, non-current asset, then total equity and liabilities. But what they have done is they just taken the asset first and liability next. Okay, but actually now the format is liability first and then asset next. Okay, don't do the T form balance sheet. I repeat again and again, engineers don't worry about these sentence. Those who are BCom and BBA, you will get 0 mark. You will get 0 mark even though your balance sheet totally is tallying if you have not done the balance sheet in this format. What they will do is asset one side, liability on the opposite side. Then they will just take a tally. That is not allowed in the Companies Act. If you do like that, that is not allowed by Companies Act. You cannot prepare like that. You have to prepare only like this. Look at this. This is a balance sheet of a company. Next, you see. This is the profit and loss account of the same company. Okay. And after preparing this, it need to be audited. Look at this. It has been audited. Okay. The chartered accountant has signed here as per our report. Okay. balance sheet is giving a true and fair view of the company. Like that, they have to check and sign. After this sign is done, then only it becomes official balance sheet of the company. Up to that time, it is just a draft. Okay. Then it has to be acknowledged by the managing director. Look at this. The managing director is acknowledging it. Chairman is acknowledging it. CFO is acknowledging it. Okay. So after these signatures are done, it need to be published in the newspaper or in the public domain, any other medium. It's compulsory. Okay. We'll take some 10 minutes break now. After the break, we'll come and prepare these two statements for taking some figures. Okay. Yes, thank you. Okay, can we start?
Yes, Professor.
Yeah, Professor, we can.
Okay. So I can see the reduction in number, right? Depreciation is there in the class. Okay, all right, let us start. So as I told you, profit and loss account and income statement need to be prepared once in a year, but unaudited profit and loss account and balance sheet will be prepared once in 3 months. You might have seen in the newspaper, unaudited financial statement of so-and-so company. Once in 3 months, it will be displayed in the newspaper. Okay, so that is only for informing the shareholder to tell where it is going, the company, how it is, tentatively how it is going on, for that reason. But that is not a audited one, but we can guess how the company is performing. But this is final one. Okay. Yes, I have downloaded from LMS only. It is there. It is there. All right. So let us take one small question and try to understand how the preparation of profit and loss account is taking place. Okay. The illustration 1, what you are seeing in the screen, is about statement of profit and loss. It's a trial balance actually. By this time, you know what is trial balance. You are preparing on it, right? You are preparing the trial balance for your assignment. Look at this. As I told you, you have trial balance. You should have trial balance, otherwise we can't prepare financial statements. Okay. So there's a trial balance of Siraj Company Limited as on 31/3/2019. Okay. So this is debit side actually. A trial balance you might have prepared in another form. That means serial number, name of the accounts, debit, credit. That's fine. And this also another way of doing a trial balance. Okay. One side itself is a debit side, another side it's credit side. Okay. Right side is credit side, left side is debit side. Look at this. Depreciation on premises 8,000 rupees. Materials consumed is given. Opening stock in trade is given. And then salaries, bad debts, bonus to employee, interest on loan, depreciation on machine, conveyance account 4,000 rupees, loss on sale of machine 20,000, insurance premium paid 16,200, sales return 40,000, provision for tax 60,000, machinery value itself is 6 lakhs, PF contribution is 86,000, premises value 1,60,000, computer account value is 40,000. The total of debit side is 20,46,000. Similarly, right side, sales account 12,40,000, equity share capital 8 lakhs, outstanding wages 6,000. The total is Same 20,46,000. From this, we have to prepare profit and loss account. And one more additional information, that is adjustment, that is given under the trial balance, that is closing stock of raw material is 1,20,000. Closing stock of raw material is 1,20,000. Okay. So with this information, we are going to prepare the profit and loss account of the company. Profit and loss account. Right. So this is the profit and loss account. Statement of profit and loss. Profit and loss. Statement of profit and loss. Take the format. Particulars, note number, amount. Okay, this is the format. We have to remember this. Revenue from operation plus other income is equal to total income, total revenue minus expenses. Point number 1 is raw material consumed. Second one is purchase of stock in trade. Okay, purchase of stock in trade, and then change in inventories. Change in inventories, then employee benefit expenses, finance cost, depreciation, and other expenses. Total expense minus this total expense from the total revenue, you will get profit before tax, then minus tax is equal to profit after tax. Okay. So now in this question, what is the revenue from operation? Sales is revenue from operation 12,40,000 that I have taken here and written 12,40,000, but there is sales return. Yeah, sales return is there. 40,000 rupees sales return is there. So I have prepared a small note. Look at this. A note is prepared here. That is sales minus sales return. Sales minus sales return. 12,40,000 minus 40,000 sales return, that is equal to revenue from operation. Revenue from operation. Okay. This 12 lakhs, I'm writing it in the profit and loss account. 12 lakh. Yes. Understood? What is understood? Yes, sir. You only. What is understood? $12 lakh. Credit side. How did I get the 12 lakhs? Sales is 12,40,000. Sales return is given in the question as 40,000. So 12,40,000 minus 40 is equal to 12 lakhs. That is called revenue from operation. That is done in note number 1. That note number 1 is here. Okay. Who? In real time. Yes, this notes also. Note also. Note to accounts is also a part of financial statement only. Okay. Right. Then we need other income. Scan the given trial balance. Go through the given trial balance. Is there any information about other income? Where you can find this on LMS? You are opening the question in LMS. Which question you are opening? Question is there, no? You can, unit number 2. In LMS, unit number 2, there will be on Word file. Is it not there? That file only. That you can't see. Page number.
It is there.
It is there, yes. I have one supporter, it is there, yes. Yeah, it is there. I have not taken from anywhere. I just downloaded this from LMS only. Yeah, okay. So next item, other income. Other income, if you look at the trial balance, we don't have any information on other income. Income will always be in credit side. So look at the credit side. Credit side only we have 3 items. One is share capital, another one is sales, another one is outstanding wages. That's all. Okay. So there is no other income. So I'm putting 0. Other income is 0. Other income is nil. Then total income is 12 lakhs. 12 lakhs plus 0 is equal to 12 lakhs. Okay. Next. Next, expenses. Okay. Expenses one by one. First one is material consumed. It is given in the question, check it. Material consumed is given in the question as 8 lakhs. 8 lakhs is given in the question. Materials consumed. Okay. So that I have taken. Just I am marking it only for our reference, which is already used. Okay. So material consumed is 8 lakh rupee. Materials consumed is 8 lakh rupee. That is raw material. Just for understanding, I have written. Okay. Then purchase of stock in trade. Is there any purchase in this question? Purchase will be there in the debit side only. Is there any purchase? No. So I'm writing it 0. Purchase of stock in trade is 0. Then change in inventory. Change in inventory we have to calculate. How do you calculate change in inventory? Change in inventory. How do you calculate it? Opening stock of stock in trade plus work in progress plus finished goods minus closing stock of these 3. Closing stock of stock in trade, work in progress, then finished goods. Okay. Check in the question. Opening stock in trade 40,000. Okay. Opening stock of finished goods. No. Then which one, sir? Okay. Negative 80,000. Okay. If you're understanding, negative 80,000. Negative 80,000. Two amounts are only there. One is, yeah, opening stock is 40, closing stock is 1,20,000. So it is 40 minus 120 is equal to 80. Minus 80. Look at this. Minus 80. Minus 80,000. Minus 80,000. So I have written here minus 80,000. Minus means it's bracket. Okay. Minus 80,000.
Professor, one question. Can we write even minus also there instead of bracket?
Yes. Yes, you can. Yeah. Okay. You can write it. Yeah. Next. Next, point number C. What is point number C in the format? Point number C is only change in inventory. That's over. Point number D is employee benefit expense. Look at the trial balance debit side. Employee benefit expense. Salary, bonus, salary, bonus, then anything else? Insurance for insurance for employee.
PF contribution.
PF contribution. Okay.
Conveyance.
Computers purchase.
Which one, sir? Conveyance. Then that's all. But conveyance, why you want to write it under employee benefit expense? Huh? Conveyance goods are conveyed from one place to another place. How many companies? Okay, that is not clear means you just write a note, but conveyance normally it's not for people. It's for the goods transported, and again Conveyance is not a employee benefit expense. Conveyance. If it is employee conveyance, of course you are right. You have tried it there only. Okay. So we have three only. That is salary, PF contribution, and bonus to employees. The total is 2,20,000. 1,14,000 is in the form of salary, and then 86,000 is in the nature of PF contribution, and bonus to employees 20,000 rupees. Put together, 2,20,000 is the employee benefit expenses. That is written over here, employee benefit expense, 2,20,000. Okay. Any doubt in this? Okay, next one is finance cost. Look at the trial balance. Finance cost. Is there any finance cost there?
Interest on loan.
Interest on loan. Interest on loan. Bad debt is, what is bad debt? Huh? Yes, sir? Not?
Lenders didn't pay it actually.
No, what is bad debt? Don't tell me the list. What is bad debt? What is your understanding about bad debt? Irrecoverable amount from the customer. Okay, so that is called bad debt. Is it a finance cost? Actually, if you speak in that way, it's a marketing cost. Why the debtors are not paying the money? We brought somebody and we have sold some goods to him. Even though he does not need, we told him, take it, give the goods, give the money later. Just like your subprime crisis. I don't want any house. I am okay with my mobile house. You know mobile house? Don't know? Mobile house. Okay, in the old bus or something, I make house and reside there only. I'm not a citizen of America, USA. But you people are giving loan because you have money. You don't know what to do. You don't know the American, subprime crisis, no? 2008. Okay, subprime lending, then subprime crisis. Likewise, we just take somebody from the road and take the goods. Marketing people will do like that. You used to get a call. They don't even bother what you are doing. They just tell, I am so and so. Can you take your 1 minute? I'm calling from HDFC Bank or ICICI Bank. I want to give you a bank personal loan. Lowest interest 15% or lowest interest 11%, like that. So that is called marketing, right? They have to sell it. Otherwise, they don't sell it, means all these things will not come. So by the time you sold it, but some customers, what happened? They are not able to repay. So they're not repaying it. That is called bad debt. Irrecoverable amount from the customer is called bad debt. So that is no way connected to financing of my company. So it's not a finance cost. Anything else? Bank charge, any bank charge is there? No. So finance cost is only 16,000 rupees. That's all. Finance cost is only 16,000 rupees. Okay. Next, depreciation and amortization expenses. Look at the debit side. Yeah, depreciation on premises is 8,000. Then depreciation on machine is 18,000. Then that's it. So these two need to be added together, and that is called depreciation and amortization expenses. 8 plus 18, 26,000 is going to be the expense of depreciation and amortization. Yes. Other than this, anything else is there that is called other expenses. Look at the trial balance. Okay. Opening stock we already considered. Outstanding wages. Outstanding wage is an expense only, but already it is taken. The outstanding expense is given as a liability. It's only liability it's given. Suppose it is given under adjustment, then you have to take it. Okay. Now, anything else is there? Yeah, bad debts, conveyance, loss on sale of machinery, insurance. These are all the other expenses. Bad debts, conveyance expense, loss on sale of machinery, and insurance. These are all the other expenses. Look at the other expenses. Yeah, other expense, bad debt, conveyance, and then loss on sale of machinery, and insurance. All these four put together, we get 44,000. That 44,000 is brought here and it is written under other expense column, 44,000. Now you are done with all the expenses A, B, C, D, E, F, G. You have to add these 7 items. Okay. Of course, one is 0. So all other items to be added. That is equal to 10,26,000 is the total expense of the company for the year. You remember the beginning I told you income minus expenditure is going to be profit. That is being done in the statement, but income is happening in throughout the year as well as expense also happening throughout the year. But to report it to the stakeholder, we have to have some columns. So in that column, we are reporting. Okay. As per the law, one more thing you have to understand. We prepare 2 profit and loss account. One is for Companies Act. This profit and loss account will not be accepted by Income Tax Department. Income Tax Department will not accept the profit and loss account prepared under Companies Act. Why? Companies Act is giving you little liberal hand to recognize your expenditure. If you take this 1,74,000 as profit, I may end up in paying some amount of tax. But Income Tax Department wants to know whether this 1,74,000 is the real profit according to Income Tax Act. What is the difference between Income Tax Act and Companies Act? Companies Act is more concerned with the stakeholders. You should not get the people cheated. Okay, but Income Tax Department is more concerned about income to the government of India. You cannot just show depreciation here as 26,000. Of course, Companies Act also is telling what kind of asset, what rate of depreciation is there. But if you increase the amount of depreciation, what will happen to profit? If you increase, if you inflate the depreciation amount, what will happen to the profit of the company?
It will come
It will
down.
get reduced. What is the use for the company? To show the lesser profit. Income tax will be less. If your income tax to be reduced, you can show over depreciation, over absorption of depreciation. Okay, so that kind of changes. Please understand that is not our subject matter, but just I'm telling you, this is the profit and loss account. What you are seeing in the newspaper, what you are seeing in the website of the company is according to Companies Act. Okay, one more profit and loss account, they will prepare that need not to show to anybody. That is only to be shown to Income Tax Department. That's it. Okay, there some mismatch will be there between this income and the income reported under that profit and loss account. There will be mismatch. According to that profit only, you are supposed to pay tax. That is why here we are taking provision for tax. It is not actual amount paid. We just assume this is a profit. Okay, we will have this much of income tax. So we'll have this provision. Okay, later you'll pay. So from the 12 lakhs, which is the total revenue, you are minusing the total expense. Okay, that amount is called profit and loss before tax. Profit before tax. Actually, it is profit before tax. But in the format, you write profit and loss before tax, depending upon the sign. Suppose if it is minus sign, it is loss. If it is plus, it is profit. That's it.
Sir?
One second, madam. Yeah, one of your classmates is in class is telling something. Yes. Yeah. Yes. While taking a total, just like a normal total, 4 plus 2 minus 3, like that. Okay. 8 lakh plus 2 lakh 20, 10 lakh 20 plus this minus 80. Okay, it is adjusted there itself. Yes, madam.
Got it, sir. That minus 80 itself I wanted to ask.
Same thing.
Yes.
Okay, right.
Yeah.
Okay, fine. So this 10,26,000 is the total expense that is minus from the total revenue. You are getting a profit of 1,74,000 minus tax 60,000 rupees. So it is equal to profit or loss after tax is equal to 1,14,000 rupees. Okay. So this is how you have to prepare the profit and loss account of a company. All the companies means a company which is in Europe. All companies in India should follow, whether it is listed or unlisted private or public, everybody should follow this. Difference between public and private is private limited companies statement will not come outside just like an open document. It is kept in their accounts office only. They need not to compulsorily give to anybody. But public limited company, it is compulsory. That to listed company, it is 100% compulsory. This need to be kept in the public domain. There's a timeline. You have to keep that within the timeline in the public domain. If they fail to do so, even they can be asked to wind up the company. That kind of penalty is there in the Companies Act. Okay, but everybody, they will do it. Yeah. Any other doubt before we go into the next question? Okay, look at this next question. From the following trial balance of Glory Company Limited as on 31 March 2018, prepare a statement of profit and loss as per Schedule 3 of the Companies Act. Okay, you tell me now, interest on debenture, where you will write this amount. Interest on debenture, how do you treat this in the financial statement?
Finance cost.
Under finance cost. In the profit and loss account, under the name finance cost. Next, traveling expense.
Other expense.
Other expense. Other expense. Okay. Other expense. Then delivery van expenses.
Other expenses.
Other expense. Good. Other expense. Bad debts. Bad debt.
Other expenses.
Other expense. Other expenses. And then discount. It is in debit side. This is debit side now. This is debit side. Discount is there. What to do? Discount debit side. Other expense.
Other expense.
Other expense. Purchases.
Sir, whether it will not come for sales minus discount?
Which one, sir?
Discount, sir. Sales.
Sales minus.
Discount.
Yeah, you can do so. You can do.
You can do.
Yes, you can do. Yeah. Next, purchases. Purchases.
Operating expenses.
Operating expenses. Is there any operating expense in the statement?
No.
Then why are you telling that? Purchases will come under purchase column, or if it is a raw material purchase, it should be considered as material consumed.
Okay.
To calculate material, not considered, to calculate material consumed. Okay. Now purchase is considered as, so purchase of stock in trade. If it is purchase of raw material, you have to take that to calculate the material consumed. If it is just purchase of stock in trade, separately you have to write it. Purchase of stock in trade. Okay, next, opening stock. Again, it is what opening stock? It is an opening stock of work in progress, or opening stock of raw material, or opening stock of finished goods, or opening stock of stock in trade. Depending upon that, you have to consider. Now, just it is given opening stock. Opening stock 72,000 is given. Opening stock 72,000. What to do? Opening stock of
Inventories.
inventories. Opening stock of stock in trade you have to take. Opening stock of stock in trade. In exam, you write like this. If it is not given exclusively, so you have to write. Okay, note. So opening stock of stock in trade should be used to calculate the change in inventory. Next, freight outward. What is freight outward? Freight outward is nothing but conveyance cost paid on sales. Freight outward. Freight means the transport charge. Transport charges on sales. So it's other expense. Other expense, yes. Next. Free samples. Other expense. Yeah, depreciation. Depreciation and amortization expense column. You have to write. Showroom expense. Other expenses. Bank balance.
Balance sheet.
Bank balance will not come under P&L account. It should come under balance sheet. Wages. Employee benefit expenses. Land and building.
Balance sheet.
balance sheet item. It's an asset actually. It's an asset. In profit and loss account, only income and expenditure to be considered. Asset and liability equity will not come under profit and loss account. Please understand, this is a basic concept. In exam, if you write like this, expense, you write it in balance sheet, asset, you write it in profit and loss account, I will just give you 0 only. You are not able to segregate the items into 5 category, means you have to get only 0. What are the 5 category? Equity, liability, asset, expense, income. All accounting is only based on these 5, only revolving around these 5 only, no. Nothing more than this. Expense, income, equity, liability, asset. Asset, equity, liability should go to balance sheet. Income and expenditure should only come to profit and loss account. Office equipment,
Balance sheet.
balance sheet item. Balance sheet item, right? Insurance. See,
Other
insurance
expenses.
means
Other
insurance
expenses.
premium. Actually, insurance means insurance premium. Other expense, good. Furniture,
Balance sheet.
Balance sheet.
balance sheet item. Come to the credit side. Share transfer fees. What is share transfer fees? Brokerage charges. What is brokerage charge? So what is your problem then? You are a company. You are Infosys company. I am selling the shares what I have in your Infosys company to X person. He is buying from me. How does that affect you? That's what I'm asking you. What is share transfer fee? To whom you will pay?
Underwriters.
Huh? To whom you will pay?
Share transfer agents.
You are buying the share from me, then how do you pay the money to the company? Go and get the share also from company.
To brokers.
One second, sir. Online people, one
Stock
second, listen.
brokers.
One second, listen, 1 second. Yeah. Share in the Zerodha, not share in the Zerodha, share through Zerodha. To whom you will pay?
Share
To
brokers.
Zerodha or to the company whose share you are buying or the person who is selling to you. That's it. Then how does that company get affected? I am selling, you are buying the shares of Infosys Limited through Zerodha. You are giving money to me. I am giving the share certificate to you. This thing is happening through Zerodha. That's it. Now, how does Infosys get affected? How does Infosys know this, first of all? But they should know, no? Not confusing, simple. See, there are thousand people are there in as shareholder in Infosys. They will maintain one record. That is not accounting book. Please understand. The name, PAN number, bank account, address of the shareholder will be maintained by the respective company. Then only they know who are their shareholders. But that is not accounting book. That is simply a shareholder book. Name of the share register, that is called share register. Share number 1923451 from 192369. From this number to this number, share is being held by so and so person. His PAN number is this. His bank account, what has given to us is this, and his address is this. Like this, one register will be there. If 1 crore shareholders are there, in that register, 1 crore names will be there. Okay. Now, Rajesh is a shareholder of Infosys as of today. He is coming to Zerodha and he is selling the share through Zerodha stockbroker to you. Now, when the payment is done, Rajesh will surrender the share certificate to you. You have to give the money worth of that one to Rajesh. That's it. Now, in Infosys book, whose name will be found as of now as a shareholder? Your name or Rajesh name?
Rajesh name.
As of now, Rajesh name will be there. Now, this transaction need to be informed to Infosys. Okay. Those days, how it was happening is, you as a buyer have to write a letter to the company whose share you bought it from whom you bought it. Okay, from which number to which number. Share will be numbered. Share certificate will have number. Okay, from which number to which number, how many shares you bought it. For how much you bought it, no matter. You bought it. You have to write to the company, attaching the Xerox copy of the share certificate. They will receive it manually in the post. They will verify everything. Then they will be changing the name from Rajesh to your name. For that, you have to pay some fees. That fees is called as share transfer fee. Now, the share of Infosys held by Rajesh has been transported to the new buyer. For that, the new buyer has to pay some money. That money is called as share transfer fee. Now it is happening instantaneously because of computerized environment. Now Zerodha will inform to the DPs, depository participants, okay, where you are having your demat account. Okay, from there it is captured by some of the share registrars are there. They will capture this and they will maintain this process on behalf of the company. The company will pay annually some money to them. The company will not do this process because company is having a lot of work to do, developing a software and selling it. Okay, they won't interfere in this kind of activity. There are some intermediaries, they will take care of this activity. But for that, they have to pay some money. That money will be collected from the shareholder. Okay, that money is called as share transfer fee. So it is income or expenditure or asset or liability or equity.
Income.
Income. It's an income. It's an income. How do I simply know this? This side, credit side, whatever is there is possibility only is asset, liability or equity or income. Income, equity, liability will be in credit side. Expenditure and asset will be in debit side of the trial balance. Okay. Now, so this should be considered as other income. This should be considered as other income. How much it is? 15,000. But it is not considered as other income. Why? 15. One more income is there? Yeah. 15,000 and the commission received is 7,400. So total is 22,400. Okay. Right. So this is income, other income.
So one doubt.
Yes, sir. Yes, madam.
This share transfer fees. Now in this example, we discussed about Infosys share. So this fees will go to Infosys or to Zerodha?
These fees has come to Infosys only. That's why it's in the trial balance of this company.
Okay.
Then later they will pay some money to not Zerodha. Please don't misunderstand. Zerodha will not have any connection with Infosys. Zerodha will have connection between you and the seller. The buyer and the seller will have connection with Zerodha. That's all. And even sometimes seller may not be connected to Zerodha. Buyer only may be connected to Zerodha. The seller's demat account will be there in some other DP and they might have taken some other broker. Say for example, ICICI Direct can be my broker. Zerodha may be your broker. Okay. Now these two brokerage organization will be doing facilitating the trading of stock through internet. That's all. Okay. So sometime buyer and seller may be having a connection in the same broking organization. Most of the time it is not necessary also. Because how do I know where you have account? And how it is done? It is not done in Zerodha. That's what I told you. It is done through Zerodha. Then where it is done? It is done either in NSE or in BSE through their softwares. Okay, you will study later if you take finance as a specialization in the next coming semesters. But now you understand Zerodha will not give any money to Infosys. You as a buyer, if you are the client of Zerodha, you have to pay a commission of purchase 0.01 or 0.015 like that. Okay, brokerage. That brokerage is the income for Zerodha. Then who is getting this money? From the buyer, the company is getting the money. Which company? The Infosys in our example. From the buyer, Infosys is getting money for changing the name to insert your name in the share register of the company. But that is done by some third party nowadays. Outsourced. That work is outsourced by all the companies. Okay, they are called as share registrars. Okay, right. You got it, sir?
Yeah, clear, sir.
Yeah. So next item is 12% debenture. What is this 12% debenture? It is the
Liability.
liability. It is a balance sheet item. It's a balance sheet item, right? Then commission received is other income. Sales is a revenue from operation. Share capital is
Liability.
equity.
Equity.
Share
Shareholders.
capital is equity. Of course, it's a balance sheet item. So remaining all is a profit and loss account item. That's what we prepared here. Revenue from operation 6,45,500. Before that, look at the note to accounts, other income,
So you
inventories.
said the credit will the credit side will always be coming under what to say equity, but here one of the liability factors also coming into play. Na?
Sorry, come again. I could not get you the first few.
Just
Yeah. Yes. There is some network problem. Okay, when he gets connected, he can ask, no problem.
any bifurcations there for debit side, it can be classified only with for say liability and like is there any segmentations are there for the credit and debit side?
No, you were asking about the trial balance.
See, yeah, the trial balance.
Ah.
There is a credit side is there in the right hand side, correct?
Yeah, this side is fully credit side. Yes.
Yes. So what there are total 5 main elements are there in the accounting. Okay. So when when I see something in the credit side, okay, what are the possible things it can be put it into?
Just now I told you, no, on the right side, in the credit side of the trial balance, only, it's not just possible, it's only equity, liabilities, and income. Only these three things can be there in the credit side of the trial balance. Then what can be in the debit side of the trial balance? Asset and expense. Only, it's not just possible, it's only out of 5, 3 on the right side, 2 on the left side, 2 on the debit side, 3 on the credit side. Yes.
Okay, got it.
Good, good. Yeah. Next. So based on this, yeah. In balance sheets, we have 3. We have to take from the trial balance to the balance sheet only 3 things, that is equity, liabilities, and assets. Okay. Out of that, under equity, you have 2 things: share capital, reserves and surplus. Share capital can be directly taken from trial balance to balance sheet. Reserves and surplus need to be worked out based on the last year reserves and surplus, current year profit and loss, the decision of the board to how much transfer to reserve, and balance will be in the surplus. That working is called as statement of retained earnings. In accounting, actually, current year profit, last year profit, both are available to you to distribute that as earnings to the shareholder, dividend to the shareholder, or you can retain that in the business for the further development as reserve. So that can be taken in a small statement. That statement is called as statement of retained earnings. Retained earnings, but we don't prepare separately. The tail end part of the profit and loss account is statement of retained earnings, in which you prepare the surplus and reserve also. Okay. Where? No, there is no logic. No. Income and expenditure should be used to find out profit or loss. That process is done in P&L account, not balance sheet, profit and loss account. So that will go to profit and loss account, income statement. Okay. So I request you to go through some of the questions, and answers are also given there, and you can prepare. Now let us come to the balance sheet. Yeah. Balance sheet. Okay, look at this trial balance. I think this is combination of balance sheet as well as the profit and loss account. Let us see this. Yeah, one can be a full-fledged exercise, right? Yeah. Look at this balance sheet. Sorry, trial balance. The following is a trial balance of Detergent Company Limited as on 31/3/2020. The company has 20,000 shares of rupees 100 each as registered capital. What is the other name of registered capital? Just now I told you before break. Authorized capital.
Authorized capital.
Authorized capital. Registered capital as well as authorized capital are one and the same. Okay. The company can raise up to 20,000 into 100. That much amount it can be raised. Okay. But the company has raised only 3,000. Look at this. Shares 3,000 shares of how much? 100 each. That is equal to 3 lakhs credit side. It is given in credit side. CR means credit side. Okay. Okay. Calls in arrear. What is this calls in arrears? Calls in arrear means advance. Arrear means not advance. Arrear means delay, default. See, I wanted to raise 3 lakh rupees from the public. They also agreed to give. But finally, somebody did not give that worth rupees 16,000. So it can be minused from share capital. Okay. Reserve fund. This is balance sheet item. This also balance sheet item to be minus from the capital. Third one, reserve fund is the balance sheet item, which will come under resource and surplus heading. Okay, next building. Balance sheet, which heading?
Assets.
Long-term assets, which heading? Fixed asset. Fixed asset, which heading?
Tangible.
Tangible asset. Balance sheet. Why, madam? Capital work in progress. Building. Building is finished one or process one. After the process, we'll call that as a building. During the process, we'll call it as building under construction. It is not under construction, it's already constructed. Okay. Fixed deposit, which is given in the credit side. You have to look that also. Fixed deposit, but amount is in the credit side. So where you will record this in the financial statement of the company. First of all, you decide out of these 5, what is this? Out of these 5 items, what is this? Liability. Because it is given in credit side. It can be either liability or equity or income. Fixed deposit can never be an income. And it is not equity also. It's not owner money. So it's a loan taken from somebody in the name of fixed deposit. Please understand, companies can also take money from the general public in the name of fixed deposit. But no, all companies cannot take it. Only reputed companies, after taking permission, it can do. So fixed deposit 1 lakh rupees. So it is a liability. So it will be a balance sheet item under which heading? Under liability and equity. Okay. Under which heading? Long-term borrowings. Okay. Next, wages, employee benefit expense. Employee benefit, machinery,
Tangible assets.
other expense. Madam, machinery. Machinery means what? Fixed asset. Machinery.
Tangible
Understand? Machinery, computer, motor van, building, land, premises. All these are assets. Okay. So building is an asset. Under tangible asset in balance sheet, you have to write it. Furniture.
Tangible asset.
Under balance sheet, under fixed asset, under tangible asset. Purchases and sales. Look at this. Don't get confused. Purchase and sales is given. Amounts are given in both sides. Debit side as well as credit side. Debit side amount is for purchase. Credit side amount is for sales. So sales is a revenue from operation. Purchase is the expense.
Purchase.
Salary.
Expense.
Employee benefit expense. Debtor and creditor, balance sheet item. Debtor amount is in debit side, 2,20,000 should be recorded under balance sheet, in current asset, under
Debtors.
under debtors. There is no debtors in the format. Check it. There is no debtor in the format.
Current assets.
That's okay. Current asset, we have so many. A, B, C, D is there.
Trade receivable.
Trade receivables. Under that, you have to write debtors amount, creditors amount, trade payables in liability under current liabilities. Okay, BR and BP. BR means bills receivable. BP means bills payable. Same logic of debtor creditor. Okay, the debit side of 61,000 should be written in current asset under the name of trade receivable. Add with debtors. Debtor and receivable to be added together. That will constitute as trade receivables. Similarly, creditors and bills payable to be added together. These two amounts to be added together to get your trade payables, which need to be recorded under current liability under balance sheet liabilities. Okay, right. Director fee. Expense, okay, but what expense? We have A to B, C, E, D, F, G. Other expense. Returns. What is returns? Returns, debit side is sales return. Return, credit side is
Purchase
return. Minus from the respective amount. That's all. Freight.
Other expenses.
Freight is other expense. Or sometime what you can do, freight you can add with purchase. If it is freight inward. What is freight inward? Commutation charge paid on the purchase of goods. So you can add with purchase. No, sir, I don't want to do that. Take it to other expense. Manufacturing expense, other expense.
Other expense.
Other expense. Opening stock to calculate
liability.
Change in inventory. Okay. Interim dividend. What is interim dividend? What is dividend actually?
Portion of profit.
Yeah, portion of profit given to the shareholder.
Balance sheet item.
Sorry. Okay, portion of profit given to shareholder. What is interim dividend?
Distributed in 6 months or half yearly.
Okay, just like your midterm exam. Okay, we don't want to wait till the last day of the end semester examination to know your performance. We are just having one exam in between. Likewise, we think that company is doing good. To encourage the shareholder, we are giving some amount as dividend based on the unaudited profit and loss account, which is prepared within 3 months once. Okay, so we are giving it interim. Interim dividend is one which is given in between two final dividends. In between two final dividends. So it is
balance sheet item.
Balance sheet item. Why?
Other expenses.
Somebody is from online telling other expense. Yes, sir. You out of our
liability.
So partly you are right. So actually it's not a balance sheet item. To calculate surplus, dividend can be used. Suppose it is not expense. Please understand, first of all, it is not expense. Dividend is not expense. Dividend is allocation of profit. Allocation of profit. Dividend is outcome of profit. Dividend is not against profit. If profit is there, only dividend will come. It is not like interest. Interest is against profit. More and more interest, less and less is profit. It's against profit. But dividend is out of profit. Allocation of profit. Okay, what to do? Current year profit is 1 lakh rupee. You are giving dividend of 20,000 rupees. So 80,000 only can be used to calculate your reserves of current year or surplus of current year. 1 lakh is your total profit of the current year, net profit after tax. Out of that 20,000 rupees you are giving as dividend. Remaining 80,000 is available for you to make a retained earnings or to allocate some amount from there to reserve. Okay, so it is to be minused from profit to find out the surplus or to find out the reserve of the current year. Okay, yeah. Our profit is not to assume it is there. No, tell me yes, yeah. Your profit is, look at this. Your profit is 1,19,700. From this, we have to minus the interim dividend paid. Remaining amount is available for keeping it as a reserve, or maybe from that also you can take some amount as surplus. Suppose 1,19,700. I saw the statement. All of you, yeah, thank you for this. There is a computation here. Look at this. Yeah. Look at this. Opening balance of the profit and loss. That means current year you are going to calculate the profit. Already last year they calculated the profit that is there in the trial balance of the company. That is 27,000. Can you see that? In the trial balance, you may have this amount of 27,000. Look at this. Yeah. What is this 27,000? This 27,000 is nothing but the surplus of the company at the end of the last year, beginning of the current year. Okay. Plus current year profit I am earning. How much I am earning? 1,19,700 I am earning in the current year. How do I know? That is from profit and loss account. Net profit for the year. For the year. Okay. Opening balance of profit. Okay. Now total amount, total profit available for allocation, is 1,46,700. Are you able to understand up to this now? Last year profit was 27,000, which was not distributed, kept in the business in the name of profit and loss only. Current year profit earned is 1,19,700. The total profit available for allocation is 1,46,700. Allocation means what? I can either give us dividend, or I can take it as reserve. Okay, that is decided in the board of directors meeting or in the AGM. Okay. Now, in this company, what is the interim dividend? Interim dividend in the trial balance is?
So declared but not paid.
21,000. Where it is?
No.
Yeah. 21,368, and company has paid 3,632 rupees as tax on that dividend. That is changed now in the current, now the next year onwards it's changed. Okay. Normally what happened? Dividend in the hands of the shareholder is fully exempted from income tax. That's the rule that was in India previously. Okay. Indian companies giving dividend to us is completely exempted from income tax. Suppose I'm receiving 1 lakh rupee, okay, or 50,000 rupees, exempted from income tax so far. But government will not live like that. Don't be that much happy. But what the government will do? Government will ask the company to pay the income tax on behalf of all of us, shareholders, to encourage the people to invest in companies, in equity shares. So total amount is 25,000. 21 plus 36232 plus 368. So totally 25,000. Interim dividend paid is 25,000. So I have taken that amount minus here. Look at this. Minus 25,000. Minus 25,000. Okay. 25,000. Next, proposed dividend. I think there is a further dividend the company is proposing. Look at the question. Yeah, directors proposed a total dividend of 25% on paid up capital. 25 total dividend is 25%. So 25% of paid up capital. What is paid up capital? Paid up capital is nothing but 3 lakhs minus 16,000. Paid up 3 lakhs minus 16,000. How much? 2,84,000. On 2,84,000, calculate 25%. On 2,84,000, how much is 25%? 2,84,000 into 15. I mean 25%. How much?
71,000.
71,000. 71,000 is the total dividend. 71,000 is the total dividend to be given by the company to the shareholder. 71,000. Look at this 71,000. But already how much I given? 25 I have given. Still payable is 46,000. Or put together is 71,000. Okay. 71,000 to be taken away from the profit, which is given as dividend. Okay. Then company is deciding to transfer some amount to reserve also. Look at this. The company is deciding to transfer 60,000 rupees from the profit to reserve. So that also minus reserve. Minus transfer of reserve. 60,000. Okay. This is minus, this is minus, this is minus from this total amount. How much is equal to 1,46,700 minus 25 minus 46 minus 60. Calculate. Nobody's calculating. Is it 15,700? 1,46,700 minus 25,000 minus 46,000 minus 60,000 is equal to.
Sir, can I
Yeah.
once again
Correct,
explain
sir.
why that proposed dividend is?
1 second, I'll explain to you. 1 second. Let me complete. I'll explain to you. Yes. Is it 15,700? This 15,700 is called as surplus. Previously, the opening balance of surplus was 27,000. Now, the surplus is 15,700. This 15,700 should come under resource and surplus under the name surplus. Then what is reserve? Look at the trial balance again. Opening balance of reserve, how much it is? It was reserve. Look at this reserve. Where is reserve? It was there? Yeah, reserve fund. Where it is? 2
Top
lakh?
it is there, sir. Reserve fund.
Yeah, 2,50,000 was the opening balance of reserve. How much reserve we created from the current year?
15,000.
So total is equal to. Look at this. Original balance was reserve and surplus. You have to put it together. Reserves and surplus. Surplus we already calculated 15,700. Reserve we have to calculate now. Opening balance of reserve. How much was there? 2,50,000 plus current year reserve. Look at this. 2,50,000 is the opening balance of reserve. We are creating from the current year. We are creating from the current year. Look at this. Yeah, we have taken from the current year profit 60,000 rupees as reserve. So 60,000 is the current year profit converted to reserve. So total reserve will be equal to 3,10,000. Then how much is the surplus? Closing balance of surplus 15,700. So total resource and surplus is going to be 3,25,000. Okay, 15,700 is alone surplus. 3,10,000 is the reserve. Put together is resource and surplus. That is equal to 3,25,700. That need to be recorded in the balance sheet in the name of resource and surplus according to note number 2. You got the point? Yeah. So this is how you have to do with resource and surplus. Okay. Where we are now? Yeah, fixed deposit, wages over, machinery over, furniture over. Yeah, director fee. Yeah, freight. Yeah, opening stock. It is used for calculating the change in inventories. Okay. Audit fee.
Other expenses.
Other expense. This we already used in calculating the resource and surplus as well as the surplus. Yeah. Tools. What is tools?
Tangible assets.
Tangible assets. Tools. Tools can be treated as asset or it can treat it as expense also.
Represent maintenance we can take.
Tools used. If it is there, it is an expense, other expense. Otherwise, you can treat it as a current asset. Preliminary expense. Yeah, okay. What is preliminary expense?
Incorporation expenses.
So, yeah, incorporation expense. To start a company, you have to do some legal formalities, and so many expenses are related to that. That expense is called as preliminary expense. We can't just take that expense as expense to be minused from income. To start a company, you spend something. That expense benefit is going to be there forever in the company. Say, for example, registration charges, legal charges, all those things. So what we do normally is we will apportion that expenses for several years. We call it as deferred revenue expenses. We don't debit all those expenditure to P&L account. Meaning we don't consider the total amount of preliminary expense as expense in the P&L account. We take one small part of that every year. Okay, say for example, here it is 60,000. In the adjustment, you see, write off 25% of preliminary expenses. That is called current year portion. So we are going to nullify the preliminary expense within 4 years. Every year, 1/4, 1/4, 1/4, we are going to take it as revenue expenditure. 3/4, the rest of the part is going to be asset. Other current asset, you remember? There is one item, other current asset. There you tried 75% of the preliminary expenses. 25% you tried it in P&L account under the name of other expenses. Okay, look at this. Other expense. Yeah. Look at this, other expense, preliminary expense written off. What is the total of preliminary expenses? 16,000. 16? 60. Out of that, 1/4 is 15. That 15 is taken here. Remaining 45 should have gone to balance sheet. Yeah, look at the other non-current asset, 45,000. Okay. Next item. Next item is debentures. You know very well, debenture is a long-term borrowings, liability side of the balance sheet. Interest on debenture. Other expenses.
Finance expense.
Finance cost. Interest on debenture is a finance cost. Okay, finance cost, interest. Investment. Current assets.
Current
How do you
assets.
know it's a current asset? Is it given short-term investments? It is not given short-term investment, no. Inventory. Madam, investment is nothing but an asset. There is no doubt. Now, doubt is whether it is current asset or non-current asset. Nothing is mentioned here, so treat it as non-current asset. Non-current, a fixed asset. Non-current asset, under that investment, one column will be there. You cannot write just like that. Look at this. Non-current assets. Non-current assets. Where it is? They have taken current asset only. 1 second. In the balance sheet directly they would have written, because only one item is there now. Yeah. Yes, see, 2 lakh. Directly they have written it here without a note number, because only one item is there. That's why. So it is coming under non-current investments, long-term investments. Okay. Investment means surplus money is kept in outside the business to earn some return. Okay, next item. Goodwill. Goodwill is asset. Intangible asset. Intangible asset. But there is one adjustment. Look at this. Write off 10% of goodwill. Total amount of goodwill is 52,000. On that, 10% is 5,200. 5,200 is part of amortization. There is one expense in the profit and loss account column, no, amortization and depreciation. In that, you have tried 5,200. Look at this. 5,200 should be written in expense of amortization. Yeah, look at this.
Sir, this won't come in balance sheet.
It should come. Which should come? Goodwill should come. How much should come? 52,000 minus 5,200.
Okay.
See, please remember, these are all the items found in adjustment. So that need to be recorded in 2 places. All these things. You remember, dividend we return in surplus column also, and another one is interim dividend we added there. Okay. Likewise, preliminary expense we return in P&L account as well as in the balance sheet. Similarly, goodwill also. Then building depreciation, same logic. Same logic. Minus 2% from building, that amounts to be going to balance sheet. These 2% alone go to P&L account under depreciation and amortization. What is the building cost? Building value is 1,80,000. On 1,82% is 3,600 or 36,000. 3,600. Look at this. I minus this amount from original cost. This 1,76,000 will be taken for balance sheet. in the heading called tangible asset, along with other assets. Okay. Same nature for furniture also. Furniture. Yeah, furniture tangible asset, yes. Yeah. Okay. All these items are over? No. Insurance is there. Insurance and tax. This tax is not income tax, please understand. This is maybe GST. On premium, you are paying GST, right? That amount maybe. So it should be going to other expense. Printing and stationery, other expense. Cash and bank balance. Under current asset, there is one heading. Tell that heading. Cash and cash equivalents. Cash and cash equivalents will be having this 12,000. Okay. Next, come to this. Some items mixed in here. These are all the things we can already considered, right? But this insurance prepaid, what does it mean? Insurance prepaid, we paid in advance. How much was insurance premium? 20,000 was insurance premium. How much is prepaid? 1,500. Yes, sir. Yeah, 1,500.
Current asset.
This 1,500 is a current asset, other current asset. How much you have to take for, how much you have to book as insurance premium expense in the P&L account? Only 18,500. Okay. Good. Closing stock, we already know. Closing stock is to be treated as a variable to calculate the change in inventories. Okay. So if you do all these things, you will get a profit and you will get balance sheet. In balance sheet, just like your trial balance, the total of liabilities and equity should be equal to the total of asset. Look at this, 10,95,700. That is exactly equal to the total of assets, 10,95,700. So this is how you have to make the profit and loss account and the balance sheet of companies. So I request you, okay, I just tell you to download your own company's balance sheet and your own company's income statement and just to go through as a glance. We are not going to do anything out of that. But next chapter, what you are going to discuss is analysis of financial statements. So that time, if you don't know the items in this balance sheet and income statement, we may not be doing that analysis. Okay.
Sir, one
so
doubt.
Please down. Yes, madam. Any doubt?
That allocated stipend amount was there.
Allocated?
Stipend was separated.
Louder. Allocated time for?
No, sir. Allocated stipend, some 45,000 was minus from 71,000.
45,000 is minus from?
71,000.
Which one you're talking about?
In note it was mentioned, sir.
Which one is referring to anybody? Which
one? Stipends.
In calculation of reserve and surplus also.
Yeah, reserves and surplus. Yes.
Yes, sir. This this value 71,000. So how?
This 71,000. How did we get it? It's nothing but percentage of dividend on the paid up capital. Paid up capital is how much? 30 lakhs minus or 3 lakhs minus? Check it. The balance sheet, what is the share capital?
3 lakhs minus 16,000.
3 minus 16, that is equal to 2 lakh
84,000 into 25%.
Into rate of dividend, 25%. That is equal to 75,000.
Paid up capital minus arrears we do.
That's what arrear is there. That I might not see. Paid up capital is nothing but share capital minus calls in arrear. Share capital given the question is 3 lakhs. Am I right? 3 lakhs. Look at this. 3 lakhs is the total share capital. But we did not, we did not receive 16,000 rupees from some of the shareholders.
Yes.
Normally in those days, what will happen? They will take your money in stages. Application stage, allotment stage, first call stage, second call stage, and final call stage. Stage by stage, they will take money. Suppose one share is equal to 100 rupees. In this example, one share is equal to 100 rupees. They won't take all the 100 all together. 10 rupees in the first stage, application stage. 20 rupees maybe in allotment stage. then again 10 rupee, 20 rupee, 30 rupee, like that they will take it. The company will collect money from you in stage wise. So some of the shareholder who has given some amount, but they did not pay the full amount. The amount yet to be received from shareholder is how much?
16,000.
16,000 rupees. That's called calls in arrear. First call in arrear, second call in arrear. But in today's environment, this case may not appear, because in the IPO, what happens? You are paying entire amount in the first time itself. Full amount. 100 rupees the share price. You are paying 100 rupees only. There is no first call, second call, final call, even application money. In the application stage itself, you are paying all the money. It's of old question. Okay, in the textbook we have taken. So it calls in arrear. But later on, the company may move on to the old system, whatever it may be. But accountant should have procedure for everything. So we are minusing the calls in arrear from the face value of the share. That is equal to 2,84,000. On the 2,84,000, it is given here. Look at this point number A. The directors are proposing a dividend of 25% on paid up capital. So paid up is 2,84,000, percentage is 25. Always dividend percentage is to be calculated on the share value. Okay, normally on the face value of the share, normally, but here it is given like that, 25% on paid up capital. Okay, so 25% on 2,84,000 is equal to 71,000. That is why that is how this 71,000 has been arrived at. You got it, sir?
Yes, sir.
Yeah.
Understood.
But we have to give 71. Already we have given how much? 25. That is why remaining 46 to be taken from the profit.
For profit. Okay. And this interim dividend, why we had 3632? So it is yearly or something.
Interim dividend is given as 21,000 something.
Something, yes.
But the tax is also paid by the company. Instead of giving 25,000 rupees to the shareholder, I have given them 21 plus 3 plus I have given to Government of India on behalf of the shareholder. That is why total dividend for the company is 25,000. Okay, and again, still you are going to pay 46,000. No, in that 46,000 also, you won't give all the 46 to the shareholder. You will deduct the tax. Tax will be going to Government of India. Remaining amount will go to the shareholder. That tax is called as dividend distribution tax, DDT, dividend distribution tax, or dividend tax, simply corporate dividend tax. Okay, but that is removed in the last financial budget, I think. So that we have to rectify in the next coming questions. Okay, but question is there, we have to do that. Okay, if question is talking about interim dividend and tax, we have to consider that. We can't write it is 2022, so there is no dividend tax. We can't write. Okay. Anything else?
No.
Yeah. So this is the profit and loss account and the balance sheet. There are so many exercise questions are there, and this is open secret. One question out of this definitely will come. One question in this model definitely will come for your case study. 99% chance is there. Okay. Any question paper setter of this course, which is having a final accounts, definitely should take one question from this. That's a logic. Okay. So you have to be very much comfortable in the format first. Format. This time maybe you may be having a offline exam. If situation is improving, you may have offline exam. So you have to remember the format. Okay. Digital or your other mode may not help you. So only mode is your hard disk only. Okay, no, there is no soft disk or something. So please memorize the format. Just logically understand the format and memorize it. Okay, balance sheet as well as the profit and loss account. Any question is given, first you write that format. Skeleton is ready with you. Write it. Only then you are going to fill in the blanks. Depending upon the trial balance, you are taking the amount. Depending upon the adjustment, you are adding or minusing. Then you are bringing into the format. Then finally balance sheet is going to tally. And then don't sit so much of time only on this question. If it is not tallying, no problem. Just check it once again. That's it. Leave it. If you write everything according to the logic, that's okay. Okay. If it is not tallying, don't think that you don't get any mark. You will get mark provided there is logic followed. Okay. Any other question before we wind up the class for today?
So this particular Word file will be there in the LMS, right, sir?
The same file is there in LMS.
Thank you.
Yeah, it is there. Anything else apart from LMS? Yeah. Extension. When is the last date? Last date was over? Tuesday.
Not yet over, Professor. It's not yet over.
Not yet over. So one of your classmates here is talking for all of you. He wants, if possible, the date can be extended. Extended to Wednesday? Saturday.
Next Saturday.
And I just put it on record. There are so many people today during accounts class have been engaging in another classes. So that is not at all accepted. If your class is allotted, you have to come to the class only. Otherwise, you are absent. You can be absent, no problem. You are having all right to absent, but during the same time, you are engaging yourself in other class. That is little bit, what you can say, not good. Anyway, so it is extended to Wednesday. No, Saturday. Date 24th. 24th. Saturday is 26th.
Saturday is
Okay.
25.
Okay, 25, 12 p.m. No, midnight, 12 o'clock. That is your regular deadlines, right, in the companies and all. Okay, so based on the demand or based on the work what you are having, we are finally determining the deadline. That is 25th, midnight, 11.59.59. Okay, that is your deadline. After that, if you submit it, you will have some mark deduction. Straight away, 50% will be deducted. Not out of 20 or out of 30, out of how much you are getting. Okay. Okay, leave it. You don't push me to that end. So you will be submitting it, I know. Thank you so much. If you are not having any other question except this submission assignment deadline, we can wind up now. Thank you.
Thank you, Professor.
Thank you. Thank you. Thank you.
Thank you.
See you.
Thank you so much.
Thank you. Thank you all. Is it understandable, this profit and loss account and all?